Hello, this is Alex Lyle, Investment Manager at Columbia Threadneedle. We're appointed by Embark as the Investment Manager of the Horizon Multi-Asset Funds. I'll look back at markets over Q3 of this year and our outlook for markets in the final quarter of the year and what this means for the tactical positions we're taking around the strategic asset allocations set by eValue, based on their long-term expectations for risk and return. During Q3, equities made some further progress, but at a much slower pace than the dramatic recovery of Q2. The MSCI All Countries Index of Equities returned 3.3% in sterling. The best performing markets were Asia, including Japan, and the US, while Europe and the UK did rather less well. Equity sentiment was supported by the ongoing action by global authorities to boost economic activity and encouraging indicators following the general easing of lockdowns. Government bonds gave a small negative return in sterling, but corporate bonds did better in the general risk-on environment. We continue to favour equities. Central banks and governments are offering massive monetary and fiscal support for equities, and in many cases are expanding their programs further. In addition, economies have bounced back well from the depths of the recession. The recoveries will certainly flatten from here as the second wave of COVID bites, but we expect much less impact than first time round, with measures being more regionally targeted and aimed more at social activity than business activity. We've also been encouraged by corporate results, which have been much better than had been feared. Two recent major events have also been very beneficial. The results of the US elections appear to be positive, with Biden able to make progress on a modest fiscal package and hopefully move China trade talks ahead, while having his tax-raising wings clipped by the expected lack of a majority in the Senate. The news of an effective vaccine for COVID from Pfizer and BioNTech is clearly a huge potential benefit for global economic growth. Our preferred markets are the US and Asia-Pacific ex-Japan. The US is benefiting from a relatively resilient economy, but more importantly, the US is home to a lot of global leading companies dominating the expanding industries, the Amazons, the Googles, the Facebooks of this world. In Asia, we find a Chinese economy that's cleared the COVID hurdle pretty successfully and is on track to be the only major economy to show growth this year. Also, like the US, we find attractive investment opportunities, both in the technology world and consumer-orientated companies, targeting the huge rise in middle-class wealth across China. The region we're least enthusiastic about is the UK. This is partly a result of the poor record of managing the COVID crisis, partly the additional risk we have over Brexit. In addition, we see a fairly unattractive mix of sectors in the UK, with large exposure to oil, mining and banking, with little in the growth areas. We've recently reduced our UK exposure further, while at the same time adding to overseas equities. Throughout the crisis, we've focused on strong quality companies that we believe can weather the storm best, and on expanding companies targeting the growth areas and benefiting from the acceleration in underlying trends that COVID has triggered. For example, exposure to online retailing, online social activity, cloud computing, cashless payments, virtual meetings, and so on. We continue to favour these sorts of companies despite their strong relative performance. We see a pretty healthy background for government bonds in light of very low interest rates, massive quantitative easing programs investing in bonds, and we believe inflation will remain very subdued. However, at current low yields, we see little value. In the bond world, we see best value in corporate debt, where the extra yield over government bonds is fairly attractive, and QE activity in many regions includes corporate purchases. The portfolios hold no property. The investment outlook is mixed and uncertainty for the post-COVID world. More significantly, liquidity remains an issue, and the sector is vulnerable to further selling pressure if investors worry about the prospects. Hence, it was deemed appropriate to sell the property and invest the proceeds in other assets held by the funds. We're clearly investing in difficult times, but we believe our tactical asset allocation positions around E-values, strategic views, and the active stock selection in our in-house equity and bond funds should be well suited to the current environment. Thank you for listening. Goodbye.